All right, and with that, we'll get started. Thanks again for joining this webinar this morning or afternoon for those of you who are in Europe. Again, today we will be talking about all things macro and cross commodity. My name is Reid Ianson. I'm a senior economist here at Kepler. I'm joined by my colleagues Alex and Florian, who are cross commodity experts here at Kepler. Again, we're going to be breaking down everything that there is to know around macro policy, Trump tariffs, and then how that flows through to expectations across equity markets and across a number of key commodity markets. Again, all of this research is also on our Insights platform on Kepler. If you are not a subscriber, reach out to sales@kepler.com and we can get you a trial access set up to read all of our research in detail. Of course, the stuff we'll be detailing today is just a small piece of a broader amount of research that we do here at Kepler. Also, one additional note, we will be taking questions at the end of this presentation for 5 or 10 minutes. But if you have questions as we go through the presentation, go ahead and send them in and we'll work to get through them at the end of this presentation. I'm going to speak for about 15 or 20 minutes on the macro side, and then I'm going to hand it off to Alex and Florian to speak for another 15 or 20 minutes on equity and cross commodity topics. So that's kind of the agenda for today. With that being said, let's go ahead and jump forward. And first, let's take a look at the macroeconomy and some key topics around what's going on in that space. Keep in mind today, I'll really be focusing in on the United States and China, but I'll also provide some just broad growth expectations, which is right here. And so again, coming into this year, we saw global growth expectations of 3.4 to 3.45%, which would have roughly been in line with year earlier levels. However, with the tariff implementation and somewhat chaotic Trump policy, economic policy, we have scaled that growth expectation down to 3%. So again, a 45 basis point downward revision. Things we had actually revised this even lower in the immediate aftermath of the Liberation Day announcement, but it does look like Trump is maybe capitulating somewhat around tariff policy, delaying tariffs somewhat, things of that nature. So we revised it up a little bit from say a couple of months ago. So if you had sat on these calls a couple of months ago, you would have noticed we have revised that growth up a little bit. However, it's still broadly lower from levels that we had expected coming into this year. Of course, if you look across the span of countries, broad-based cuts in growth across most major economic blocs. We're specifically, again, going to focus on China and the United States today. But again, you even look at places like the European Union. We saw growth at 1.2% coming into this year, now down to 0.9%. Places like Germany are probably flat this year. And even places like China and Canada, an 80 basis point cut in growth. Japan, 40 basis point cut in growth. So the broad narrative here is, at least when it comes to growth this year, broad-based downward revisions. If we look at the United States, as mentioned, revising growth down to 1.3%, or as mentioned on the previous slide, I've revised growth lower down to 1.3% this year, down from an initial expectation of 2.5%. Keep in mind that long-term historical growth in the United States is roughly 2%. So a 1.3% growth rate is quite below that normal historical expectation. Despite the cut in growth, we do have concerns about inflation, especially when it comes to tariff implementation policy this year. That's likely going to begin flowing through to prices through the second half of this year. We do see core CPI likely getting stuck in a range near 3%. This puts the Fed in a difficult position. Yes, the economy is weaker than the historical average, but we do think that the inflation concerns will keep the Fed on the sidelines for the most part. We probably, in our expectation, expect no more than 125 basis point rate cut through the duration of this year. Again, that's slightly more hawkish than what the market's expecting. The market's typically pricing in closer to 50 basis points of cuts through the end of this year. Also, just thinking about the Trump administration, It was our view coming into this year that Trump was serious about taking on the trade deficit, working on fixing broader global trade imbalances. However, it does look like he is stepping back from these goals now. Obviously, he's kind of stepped back in his escalatory tone towards China. And more broadly, it looks like he's capitulating on tariff policy that's really meant to take on trade imbalances. You extend this out to the fact that they removed, within the Big Beautiful Tax Bill, they removed a provision taxing foreign net inflows. And also, the Big Beautiful Tax Bill exacerbates wealth inequality in the United States. So these two factors are actually the opposite of what you would likely need to pursue to really begin rebalancing the U.S. economy, the U.S. economy's large trade deficit. So again, it does look like for now kind of a continuation of the status quo that we saw over the last decade, at least for the next 2 or 3 years under the Trump administration. Just shifting back to the short term here and thinking about where the U.S. economy is, there are clear signs of deceleration across the U.S. economy. Of course, just focusing on household consumption first, which is roughly 70% of GDP. So this is the big part of U.S. growth. You can notice even starting this year, consumption expenditures were not very good. They weakened relative to late last year. We did get a surge into March as consumers brought ahead demand to outpace or front run tariff implementation, but expenditures starting to weaken again. We think that this will start to show up through the second half of the year. And again, also a good indicator of where consumption is going is evidenced through the labor market. And I would say right now, the U.S. labor market is very much in a place of stagnation, right? We're not seeing a lot of firing activity, but we are also seeing, that much of that top line unemployment number, which is pretty steady right now at 4.1%, kind of in the range we've seen over the last year. The problem is that a lot of this stability right now is being driven by a reduction in the labor force, right? Since the start of the year, U.S. labor force has contracted around 350,000 workers. A lot of this being driven by a reduction in foreign-born labor as the Trump administration limits immigration and undergoes deportations. So again, I think a lot of the supposed stability in the U.S. labor market, especially top line right now, is being supported by a contraction in the labor force rather than a robust increase in jobs, right? So again, I think this feeds through to our narrative that there is a deceleration going on across the consumer right now. This is likely going to continue through the second half. Also, looking at the investment side of the economy, again, this is roughly 23% of GDP. We did get a big tick up in investment to start the year, and you can see that in industrial production levels. Again, a lot of this, though, is really, again, to get ahead of tariff implementation, much like we saw across the consumer. And as you can see in that chart on the left, we have seen industrial production levels flatline and start to decline slowly. Even looking at employment numbers, that construction and manufacturing non-farm payroll number did show some signs of ticking up through Q1, but has weakened over the last couple of months. So again, not a lot of signs that higher tariffs are leading to a big reshoring impulse right now, which some were hoping would maybe offset weakness across the consumer. Again, I think that this reshoring narrative will take a lot longer to play out. If it does end up, taking place, you're going to need more consistent tariff policy. I think at first to really see a big uptick in domestic investment. Also, just thinking about the Fed and inflation numbers. Look, May CPI figures were relatively sanguine. We got a core CPI number at 2.6%. That's the lowest level we've seen in quite a number of months. However, again, it is our view that tariffs will start to flow through to prices over the coming months. And again, we tend to see core CPI when measured over a 6-month basis, likely sticking around that 3% level this year. And again, that's kind of pushing us into the more hawkish camp when it comes to Fed expectations. They'll probably cut 25 bips this year, and that's it. Again, that's slightly more hawkish than where the market's at. If you look at that chart on the right, pretty clear pricing in of at least 50 bips of cuts this year. But I think as we see inflation kind of reaccelerate through the second half of the year, this will put the Fed in kind of a difficult position, despite kind of what the White House is arguing for right now, which is they would like to see aggressive rate cuts. Just thinking about the longer run as well and the big beautiful bill and the outcomes of that piece of legislation, keep in mind that it does appear like this tax cut is a sizable wealth transfer up the income chain based on external estimates. The bottom 20% of American households will likely undergo a 2.2% reduction in income, whereas the top 20% will see a roughly equal increase in income. This is problematic at a moment when American wealth inequality has widened to levels we haven't seen in several decades. You can see this in the labor share of income. This is just the percentage of the economy that's going to workers in the United States. This has declined roughly 13% since 2001. And so again, we have been concerned for a while on the economic side that rising wealth inequality in America could make it more difficult to see a robust U.S. economy over the long run. And of course, it is our view that this current tax bill exacerbates those issues. Of course, we have seen a big run up in U.S. asset prices over the last 20 years. The problem with this is, if you look at the chart on the right, the bottom 50% of American households, on average over the last 20 years, have only held roughly 6.5% of total U.S. assets. So again, if you're in that bottom 50% of American households, your labor share of income in the United States has declined precipitously, whereas you have not been able to take advantage of the big run up in asset prices. So again, we've been highlighting that this could be a concern for the U.S. economy over the longer run, and it's something that's going to need to be monitored. Also, trade plays into this as well. It is our view that widening trade imbalances also lead to widening wealth inequality in places like the United States. Again, much of the reason that this has been driven lower is because firms have offshored to places like China. China politically allows for suppressed wages to be paid relative to the level of productivity of a Chinese worker. This not only drives down wages, of course, in places like China, but also drives down wages in places like the United States as well, as U.S. workers lose bargaining power, especially in the tradable sectors. The offset to this is, of course, the United States is running a very large current account deficit. This inherently implies sizable financial inflows, and you can see this via the financial account. It is our view that a large current account deficit has, again, provided a lot of foreign net inflows. This has provided persistent support for U.S. asset prices. And again, if you look at the chart on the right, foreign holdings of U.S. assets have absolutely surged far beyond U.S. nominal GDP levels over the past 20 years. And again, the problem with this is that roughly half the U.S. economy does not benefit from these foreign net inflows, and yet has seen their share of the economy decline over the past 20 years. And again, the big beautiful bill likely exacerbates these inequality concerns across the United States. And it is our view that the U.S. political system will eventually come to a point of responding to these concerns of the bottom 50%. I'm not sure it's going to come during the Trump administration, but this is likely going to be a more salient political issue over the next decade. Of course, when we flow that through to looking at China, China is very much a key driver of these global trade imbalances, a key driver of widening wealth inequality globally. Keep in mind that China's growth model is very investment heavy. You can see the chart on the right here. 42 to 43% of the Chinese economy goes to investment. Keep in mind that, again, much of this is a political decision, right? The Chinese economy is an investment-led economy because the Chinese government allows firms to pay suppressed wages to Chinese workers relative to productivity. The Chinese government also maintains a very low corporate tax rate, a very limited social safety net. All of this helps to stimulate investment, but it limits consumption and it causes large trade surpluses. So again, this causes global wealth inequality problems, and also the Chinese economic system in general is very vulnerable given the high reliance on exports to absorb all of the excess production that comes from China. Keep in mind that the US accounts for 50% of the global trade deficit. And so if the US does decide it eventually wants to step back from playing the role of importer of last resort, this very much puts China in a difficult position. And you can see that on this chart here. Chinese vulnerability is quite high in a moment of rising trade barriers. There has been an admission that a rebalancing towards consumption needs to happen. I think long-term sustainable growth in China would see the consumption percentage of GDP rise to above 60%, up from levels right now of 38, 39%. That's a considerable and significant rebalancing. We have, despite rhetoric from Chinese policymakers indicating that rebalancing needs to happen, reality is we haven't seen it. 3/5 of the 5% growth target China set out this year is being met by investment and net exports yet again. So despite the fact that we've seen a very aggressive tariff policy from the Trump administration, there's not a lot of evidence, at least this year, that China is changing its ways and trying to find a way to rebalance towards consumption. Again, you can see this in the trade balance, right? You know, you had a lot of economists last year very concerned about a very elevated Chinese trade surplus. We're exceeding those levels this year, right? You look at the chart on the left, you know, China right now is running a trade surplus north of 100 billion a year. Again, and this is at a moment when the United States has pursued very aggressive tariff policy, at least for a few months. And you can see on the chart to the right here, China's trade surplus is more than 5% of nominal GDP. That's very elevated in historical terms. It is our view that this growth model cannot continue indefinitely. It will be increasingly difficult, especially when the United States does decide that it wants to start stepping back as that playing that role of importer of last resort globally, that this model of growth will come under extreme pressure. And so China will have to find a way to rebalance towards a more consumption-led model of growth. Of course, just speaking on this consumption piece over the short run here, again, I like to show clients this left-hand side chart, industrial production levels. These are just growth levels year over year. Despite the fact that we saw pretty elevated tariffs out of the Trump administration, industrial production, it continues to hold at the top end of the historical 3-year range here. I mean, in March alone, we were in industrial production levels topping out at 8%, highest level we'd seen in more than 3 years, right? And that reflects in PMIs as well, right? China was absolutely pushing hard into investment to meet its growth target through the first half of this year. It is our view that the tariffs that have been implemented will have some lagged effects. You'll probably see some weakening in investment activity in China through the summer. But I think in our view, Trump wants to find some kind of deal with China and move on from this. And so China probably moves right back to this emphasis on investment-led growth by late Q3 and into Q4 of this year. And of course, just highlighting the consumption side of the Chinese economy, I really like to highlight this left-hand side chart. The blue line, and excuse me, I have this mislabeled here, but these blue bars are year-over-year industrial production growth. The orange line is year-over-year household consumption. Again, these are both in inflation-adjusted terms. The Chinese economy is already imbalanced towards investment, and yet they continue to see production levels and investment levels outpace consumption levels. The reality is that until we start to see this orange line outpace industrial production, until we start to see retail sales growth outpace industrial production and investment growth, these imbalances problems are really going to remain in place, right? So again, kind of going back to my narrative from earlier, that we haven't seen a lot of evidence that China's starting this rebalancing process, even though we have seen an uptick in consumption expenditures this year. that's come right alongside an uptick in industrial production levels. And of course, you can see this flow through in the rate of inflation within China. They're producing too much and consuming too little. That's going to cause deflation across the Chinese economy. And just one last point here around this process of shifting towards consumption, the difficulties that are facing the Chinese economy. I just want to focus on this very bottom bullet here. I am not convinced we will start to really see a transition away from this investment-led model until China comes to grips with who's going to bear those costs, right? Because if you're reducing investment as a percentage of the economy by 20 percentage points, someone's going to have to bear the cost of that. And there's really two parties. One, the Chinese government accumulating more debt at the federal level to pay out larger benefits to households, but also firms. Chinese firms right now, again, as I mentioned earlier, are basically allowed by law to pay a relatively depressed wage relative to a Chinese worker's productivity level. These wage levels will need to rise. Also, they'll need to pay higher corporate income taxes, which can then be redistributed to consumers. But of course, that burden means a lower margin for Chinese businesses, right? So again, these costs, whether they're and how these costs are balanced between the Chinese government through higher amount of debts accumulation and Chinese businesses through narrower margins has not really been a conversation that has taken place yet within China. Once we start to see these conversations take place, I would become more optimistic that there is some serious efforts to begin this rebalancing process. All right, with all of this being said, kind of covered a lot of short and long-term macro topics. I'm going to hand it off to Alex to kind of flow this through to a conversation around the equity market. Alex, I hand it off to you.
Thanks a lot, Reid. So yeah, as you mentioned, to start with on China, there has been some kind of fiscal stimulus that probably helped to drive the Hang Seng index. So that's what you can see in green, which is the top performer so far this year. But we think it's rather less short seller than real buy conviction. Also have in mind that the Hang Seng has been underperforming for the last 2-3 years, and we are far from the highest. I think still 30% from the highest we had 3 years ago. So of course, first half of the year has been a roller coaster for investors. It ended with markets surging equity, thanks to strong capital inflow, and as well resilient earnings, and still a lot of good momentum around artificial intelligence. So that's especially true in the US. The US is reaching new high almost every day. We have now the S&P 500 trading at 24 times the earnings. That's not the highest. We were at 26 last year, but we are a little bit higher than the historical range, which is 18 to 22. But valuation outside the US remain modest. So MSCI excluding the US is still trading below 16 times, but that's what we had over the last few years. If we look what happened in Japan with the Nikkei up almost 7% thanks to yen depreciation, which of course boosted export profits, where as well some corporate governance reform and increased government spending on infrastructure and defense. That has been true as well in Europe, up 6% year to date, especially driven by Germany with fiscal stimulus, with some strong performance from banks, insurance, and as well on the currency, the 14% appreciation of euro against US dollar improved foreign investor and helped European equity to remain competitive in the environment. Bitcoin new high yesterday, coming as well with more risk taken by investor and of course more liquidity as we've highlighted earlier. All in all, regarding equities, we are now starting the earnings season for Q2 in think in 3-4 days. The expectation are for increase of earnings of 3%. And if that's confirmed and the outlook is good, we'll probably see some further upside, but we are maybe more cautious for the US and more bullish outside the US. If we look on the next slide and look a little bit what happened by sector, you probably saw it yesterday. It was a highlight everywhere. Nvidia becoming the first company to reach 4 trillion market cap. Just to give you a little bit some figure the context, the share is up 40% since beginning of May. It accounts for almost 7% of the S&P 500. The company is doing 200 billion a year on revenues. It's nearly up 55% year on year with a net income of 100 billion. So that's a massive change on what we saw in the market for the last few years. What helped actually hedge funds in H1 is a market rotation, which has been very good from one sector to the other. So that's why a lot of quant and hedge fund strategy worked very well in H1, excluding the trend following, what we usually call the CTA, which struggle a bit in the first part of the year. Of course, our focus is to look what happened on commodities and on oil, as we highlighted here in yellow for the equities. It's still underperforming. That's something we saw for many years now. It's not the worst sector, but it's the second worst performing year to date. Of course, oil price remain negative so far this year. Could have been worse. We'll see that a bit later. And I'm not sure that the coming earnings season will support shares, as we already had a warning from Shell on weak trading performances. There could be further pressure on oil companies, especially the big oil companies. We could have some good surprise on the refining side and Canadian oil producers that benefited from improved local pricing. Next slide on the equity, and to finish this section on equity, it's one we just added because we had a kind of huge move on copper prices. Florian will cover that later in the presentation. Just having a look on copper related company, almost all increased. Of course, I think copper has been up by between 15 and 20%, depending LME or CME. So all benefited. The global mining index is up 15%, has been driven by big players like BHP and Rio Tinto, and strong iron ore and copper demand. However, and that's true in the copper industry, there are big differences from one player to the other due to operational execution, which is probably a bit more risky than other companies. So Antofagasta and Capstone Copper delivered very good results, very good operational performance. And at the other side, you had Glencore and Ivanhoe Mine, which you probably saw, that faced some issue on the mining disruption and operational during the second quarter. As a result, we had, I think it was even in the first quarter, as a result, we had, based on the listed company, we had copper production actually down in the first quarter of the year, down 1% year on year, even double-digit down compared to the last quarter of last year. But for Q2, we see early indicators that suggest for a rebound in terms of production for these players. As a reminder, our dry team is publishing every quarter what we see in terms of volumes ahead of equity players when it touch around iron ore volumes. If we move now to commodities, I will start with oil before Florian taking over on natural gas, copper, and as well soybean. So I don't want to spend too much time on oil. We already had several webinars in the recent weeks due to the conflict in Israel and Iran. Let's say there are two key points. First, starting on the positioning. As you can see, it remain structurally long. So that's the CFTC data we get every Friday. We do a report on it to create our own indicator and comments. That's something you can see on our platform every Monday. So what we want to highlight here is that despite the recent price volatility, we haven't seen a strong bullish rebuild. So the net long position last week were down 26,000. We have now a long short Z score that dropped to minus 0.1, which means a cooling speculative appetite. The Z score captures how extreme current speculative length is relative to history as a reminder. We have a Kepler sentiment score that dropped by 1 week on week that reflect fading speculative appetite. And you can see that chart at the right. We see, and I mean, it confirmed a cooling environment showing a downtrend in the net long positioning coming from less long rather than more short. So overall, the sentiment is neutralizing, but based on the positioning, we see downside risk dominating, and that fit actually with what we have from a fundamental point of view. As you can see on the next slide, we have a very strong view on oil prices, quite bearish. We saw a decrease this afternoon, but not enough for us, because we see a decrease potentially from 10 to 15 dollars a barrel by the end of the year, which is driven basically by one of the largest surplus in the oil market in recent years, so post COVID. One of the major drivers of this surplus is OPEC. We had another confirmation last Saturday, 4 times in a row they increased production, more than 500,000 barrels per day in August. That's part of the 2.2 million production cut they established 2 years ago. So the group has now committed to restore most of this volume, and there are still decisions to be made later this summer about the remaining. So that's one of the key reasons. What happened the last few weeks is Israel-Iran conflict has actually worsened the second half year surplus, because we see no more shale oil production thanks to hedging, 70 kbd, but much more importantly, it looks like that China teapot refiners are increasingly willing to purchase Iranian crude, and that could account for 350,000 kbd based on what Trump said post this conflict. Let's say so far oil price is still at a high level. We expect that coming from internal consumption from the OPEC countries during the summer, that could rise to 800,000 kbd in August. But once that's over, we should see more barrels coming to the market. Worth noting, and I'm finalizing this section right now, TI Brent spread extremely narrow. I think it's almost at $1 a barrel. That's driven by record high refinery runs and part to less exports from the US, and of course all that oil coming back from OPEC. So let's see what's happening on natural gas with Florian.
Thank you so much, Alex. Yeah, let's dive into it. So we do expect a divergence in natural gas markets. You can see this on the chart on the right-hand side, which is our in-house price outlook. On the one hand, TTF and JKM pricing is turning increasingly bearish for the second half of this year and also for next year. And that's mainly driven by a faster than expected LNG supply ramp up, notably from Plaquemines and also Canada LNG. We also see demand side softness, especially in China, which reduces LNG imports because they have very strong pipeline inflows from Russia, a record domestic production. Also, the renewable build out in China is limiting gas-fired output. Also, India is showing limited appetite due to price sensitivity. And also in Europe, we see little upside to prices in the second half of this year. The EU has added great storage flexibility, so it's easier to fulfill these storage targets. And at the same time, the contango that has been strengthening over the recent weeks has already supported robust injections. And so we forecast an 87% storage level by November 1st. Now, we said, okay, Asia, Europe, rather bearish. On the other hand, in the US, we expect Henry Hub to trend flat in the second half of this year, but to turn bullish next year, mainly underpinned by the aggressive LNG export growth, which will come in at around 17 million tons this year and will add 20 million tons next year. And overall, we expect that the spread between Henry Hub and the other benchmarks will narrow next year. Just two last remarks on Russia. The EU now wants to phase out Russian natural gas completely by the end of 2027. But of course, it's easier said than done, because if you just simply add up the remaining pipeline flows from Russia and Russian LNG imports into the EU, then you see that Russian gas still accounts for around 10% of EU demand. And if you were to translate it into LNG cargos, this roughly equates to one additional non-Russian LNG cargo per day. So not an easy task to replace the remaining 10%. There has also been recent news regarding Arctic LNG too. Our data shows that after an 8-month pause, another cargo was loaded. However, we do not expect it to find a buyer. Even a Chinese buyer is unlikely, but that's less an issue of sanctions, but rather because of the persistent technical problems that make Arctic LNG output very unreliable. Moving over to copper. So 2 days ago, a 50% US tariff on refined copper imports was announced. And as you can imagine, it triggered a sharp market reaction, with COMEX prices soaring above $5.50 per pound. And also the spread versus LME widened from 11% to 26%. Today, the COMEX premium has come off a little bit to 25%. And this indicates that the markets are still betting on a 25% tariff eventually, rather than the full 50%. So let's see. In any case, already before this was announced, over the past months, in anticipation of a tariff, US seaborne copper imports have surged. You can see this on the chart on the right-hand side. Average monthly volumes more than doubled to more than 100,000 tons per month. And not only the usual suppliers like Chile and Peru increased exports, but also some more exotic suppliers like South Africa, Australia, and also Germany. Overall, this global rush for cargoes to the US pushed COMEX, meaning US inventories, to a 7-year high, and at the same time, the LME stocks dropped to a 2-year low. Now, what does this tariff mean for the US in the short term? We see a limited impact in the short term because our flows data shows that the copper imports over the first 6 months this year were already so high that they almost at the full year total from last year. And at the same time, also the overland imports from Canada and Mexico increased by 20%. So as a result, we do not expect any acute shortage of copper in the US in the second half of the year, simply because the US inventories appear sufficient for now. On the other hand, if you look at the long term, things look different. Let's create a simple scenario. Next slide, please, by the way. Yeah. Currently, the US relies on imports for around 45% of its refined copper demand. And at the same time, ironically, the US is an exporter of copper concentrate that is mined in the US. And that's because only half of the copper mined in the US is also processed domestically. So this means that the more immediate bottleneck lies in smelting capacity and not in mining in the US. Now, if we assume that the US ramped up smelting capacity and would fully utilize domestically mined copper, this would reduce the import needs to around 14%, down from 45%. However, bear in mind that the smelter development takes at least 5 years. Now, there are major copper mine projects in the US as well. Most importantly, the Resolution copper mine in Arizona. And this project has been cleared by the Supreme Court in May, and it is targeting an output level of 450,000 tons per year. So it would be a major mine globally. However, the first output is unlikely to arrive before 2035. Now, assuming, again, it's a scenario, assuming that the US, in tandem with ramping up the mine, also increases its smelting capacity, then by the mid-2030s, the US copper deficit would turn into a narrow surplus of less than 200,000 tons. However, we expect that copper demand in the US will strongly rise until then, mainly from electrification, data center build-outs. Bear in mind that as a rule of thumb, 1 megawatt of data center capacity needs around 27 tons of copper. So meaning even in this very optimistic scenario, it's unlikely that the US will achieve true self-sufficiency in copper by 2035. Now, two last remarks on some supply disruptions regarding copper. The Cobre Panama mine already sits idle for more than 1.5 years. But we see in our data that a stockpile of copper concentrate that was sitting there since the mine closed is now being exported. However, we want to temper the market expectations because this amounts to around 32,000 tons of copper, which is relatively small in the grand scheme of things. You can see on the chart, mine supply is well above 20 million tons per year. It should also just indicate that the dimension of the recent supply disruption at the Kamoa-Kakula mine in Congo. The miner Ivanhoe subsequently lowered its annual output estimate by 155,000 tons, which is significant, but again, in the grand scheme of things, it's probably less dramatic than recent reports suggest. Now, keep in mind that just like with steel and aluminum and cars, that this 50% copper tariff is based on Section 232, meaning it is justified by a national security threat. On the other hand, the 50% tariff on Brazilian imports that were announced yesterday, they are based on the Section 301 and relate to unfair trade practices. So moving over to our Brazilian section, well, which commodity flows will be mostly impacted by these tariffs? You can see that overall, in terms of bulk commodities, Brazil is the #2 supplier to the US. And if you narrow it down to non-fossil commodities, then Brazil would even be the top supplier to the US of seaborne bulk commodities. So what is mostly affected? Steel. Brazil is the #1 seaborne supplier of steel into the US. It's #1 regarding iron ore, #1 for intermediate iron products. It's mainly pig iron, the stage after iron ore. And this dominance of Brazilian exports to the US is even more pronounced when it comes to soft commodities. Brazil is the #1 supplier to the US of sugar, of coffee, of orange juice, and even wood pulp. Now, our last commodity that we cover is a Brazilian commodity. However, it's not directly impacted by these recent 50% tariffs, but it still has profound repercussions for the US. It's soybeans. Now, the US depends on China for around 60% of its export demand. And at the same time, China is strategically cutting US purchases and replacing them with Brazilian soybeans. In the chart, you can see that's historic Chinese imports of soybeans by origin, and it also includes our in-house outlook. And the main message here is we believe that the US-China soybean trade will come to a complete halt next year. So how is this possible? On the one hand, Brazil massively ramped up exports by significant acreage expansion, and at the same time, a weak Brazilian real is supporting the country's exports in general. Now, overall, we expect that the US will not be able to sell around 22 million tons of soybeans to China, and only around a third of this could be replaced and diverted to other destinations. Also, there has been an EPA proposal last month that suggested to increase the biodiesel mandate in the US, which would boost soybean demand domestically. However, we do not think that this is even close to substituting or replacing these lost Chinese volumes. In fact, soybean crushing capacity in the US is limited and will be a significant bottleneck, even if this mandate came into effect. Our last section is commodity futures positioning, commitment of traders. So this table shows you that's a summary of our weekly report that captures the essence of what has been going on in commodity futures over the past week. And it aims to summarize this in a few main metrics. So you see we have a metric, the 4-week change, which is a metric for the strength of the current momentum, a metric for the long-short bias, a percentile to compare current levels with historical levels, and also probably the most important one, an indicator if positioning is crowded. And all of these individual metrics are summarized in the Kepler score that you can see on the right-hand side, which serves as a proxy for how sentiment is changing in a specific market. I've now picked 2 examples on how to use this data ideally. So in the around in the middle of the table, you can see silver. Silver positioning is extremely crowded by now, like all metrics indicate that. And on the next chart, you can see it's the right-hand chart. You can see how the metrics right now are at similar levels than they were in early April. In early April, we had a webinar, and there we were. You can see the red circle. We were in a very, very similar position in terms of metrics, and we anticipated a sharp trend reversal, which, as you can see, did in fact happen. And by now, positioning has again strength to similar levels. So we expect that there will be a trend reversal pretty soon again. Now, on the other hand, on the left-hand side, you can see the same long-short metrics for RBOB gasoline. And here it's the complete opposite. Position is so underweight that even a minor shift in fundamentals could actually trigger a sharp rebound. For example, if inventories tighten or if refining margins for gasoline strengthen significantly. So this was our commodity part of the presentation, and so we look forward to your questions now.
Awesome. Thanks for that, Flo. Yeah, as Flo said, we're going to take a few questions here, maybe 5 to 7 minutes. Let's go ahead and first just a number of questions coming in on the macro side. First, just some comments around the big, beautiful bill. Really just asking, this looks like it's kind of just a continuation of the status quo from the TCGA from 2017. Where is the widening wealth distribution gap coming from? That's really coming from cuts to government programs. So keep in mind that in order to reduce what would have been roughly a $4.8 trillion increase in the deficit over 10 years, if they had just implemented tax cuts, they look to cut government programs, namely Medicare, Medicaid, SNAP, food programs, food stamp programs, and also they narrowed, for example, loan assistance for students. So again, a lot of that wealth transfer is coming through, again, not only keeping taxes lower for the higher end, but also cutting government benefits, particularly Medicaid. Another question around yield expectations for the United States this year and over the longer run. Look, I think my general feeling is that U.S. yields are going to face pressure over the long run, given America's fiscal situation. If we're thinking very short run, though, just looking at the 10-year yield right now, we're fluctuating in a region between say 4.17 and 4.5. I'm tending to recommend to clients add yield or tend to buy the yield at that 4.16, 4.1% level and maybe look to exit the closer you get to that 4.5% level on the 10-year. I think if we see a significant yield breakout above 4.5% on that 10-year, I'd start to get more concerned around equity valuations. But again, for now, we're kind of holding in that range, and I think that's what we'll probably see through the duration of this year. I think the real risk is if we see a big break above that 4.5% level on the 10-year. Other questions coming through here. Alex, I'll come to you for one. Just a question around expectations for earnings across the shale patch, given the recent volatility we've seen in oil markets.
Yeah, so that is something we'll probably know in a week. I think Schlumberger and Halliburton, the oil services are the first to release. So I think the first to start, I think the expectations are quite low. That's what we can see on the valuation, on the share price performance since at the beginning of the year, and also the fact that this company didn't really benefit from the recent surge, at least from a market perspective, even if some of them hedged. So it depends if you are more lead to natural gas or oil, and also depends in which basin you are. But basically, we see that the activity and earnings will still be lower than what we'd like to see on the shale oil, especially the pure shale oil, because they still have increasing cost, while at the other side prices came lower. I think we're almost at the end in terms of efficiency, at least from my understanding. So not a lot to improve there, and probably a bit better when we speak about shale gas players that benefited from those higher prices and probably as well hedging. And for oil services, probably still a bit difficult, but they can have better news when it comes to offshore or OPEC guys in terms of providing services.
Got it. Awesome. And thanks for that. And just kind of build on that, Alex, and maybe Humayun would want to chime in here. For those of you who are unaware, Humayun is our head of oil analysis here at Kepler. He jumped on the call. Just a lot of questions around, oil inventory builds. We're in a very bearish environment right now. Generally, when you talk to folks in the market, are there any bullish factors that we should maybe be paying attention to? And I'll hand it off to Alex or Humayun if either of you want to answer that question.
Humayun, you're muted.
Yeah, sure. So yes, indeed. I mean, if you look at OECD inventories, actually the stocks are relatively low. We could be in a situation where it's starting to make sense to refill some of these strategic reserves, especially in the US. Those SPRs have been pretty low since a couple of years now, and I think the administration has talked multiple times of its willingness to refill its reserves. They've been saying they want to refill them to the top. I don't think this is going to happen because we're talking about 300 million barrels. But I think as prices we think drop, as Alex said during the presentation, we see $10 to $15 per barrel downside in the second half. It could start to make sense to start refilling those. So this is potentially one bullish factor, but that bullish factor only comes after a significant drop that we expect in the prices. Looking at in the east of Suez market, so in Asia, stocks are actually quite high. Inventories in China especially We have seen all-time highs being reached, mainly the result of new refineries and new setups in China being launched. But that is obviously, not a strong bullish signal for the market in Asia. So there is kind of a divergence between, I would say, Atlantic Basin markets and Asian markets on that front.
Awesome. Thanks for that, Hamayun. And we'll hand one last question off to Florian. Question says, given Trump has approved sending US aid to Ukraine and is looking at a bipartisan Senate bill that would levy 500% tariffs on any country buying Russian oil, gas, uranium, or other exports, what's your view on the likely effectiveness and geopolitical risks of imposing such a intense sanction and tariff piece of legislation?
Yeah, I mean, it's a complex question, of course, but I would say a first way to assess that would be to look, well, who is still buying Russian commodities? With crude, it's relatively easy. It's essentially India, China, Turkey, and some minor flows to Brunei. So would Turkey continue buying it? Probably less likely. China, India, more likely. When it comes to LNG, it's more difficult. Europe and OECD Asia together, I think, account for more than 80% of Russian LNG buying. Could they replace it elsewhere? Difficult. Like we said already, the EU wants to phase out Russian natural gas until the end of 2027. However, it's 10% of EU demand, which is significant and not easy to replace. Other commodities, diesel has also shifted, and it's mainly bought by African countries and Brazil and also Turkey. So one would need to look on a country by country basis to see, do these countries have enough geopolitical leverage to say we continue doing that or not?
Awesome. Thanks for that, Florian. All right, we'll call it there. We're right at the 1 hour mark. So yeah, we'll call it there. Thanks again, everyone, for joining this webinar. Again, for those of you who may not be aware, we do have a full research product through Kepler. If you don't have access, reach out to sales@kepler.com. And again, we cover a number of key commodity topics in far more detail than we covered even here today. So again, please reach out. But with that being said, thanks again for joining, and we'll see you next time. Bye-bye.